Tepid Jobs Report muddies Fed plans, Wall Street Journal WSJ.com. WSJ. Facebook. Twitter. Market Watch. Barron's. Smart money. All things digital. Fins. More WSJX, invitation only. Big charts. Virtual stock exchange. Financial news. WSJ Asia. WSJ India. WSJ China Chinese edition. WSJ Japan Japanese edition. WSJ Europe. WSJ Deutschland. WSJ Americas en Español. Portuguese. WSJ Radio. WSJ Wine. The Wall Street Journal. Menu. Also in WSJ.com. Share. Tweet. Markets Pulse. Top streaming coverage reverse order. Keyboard. Gaze active updates. 571,44,615. 0 new posts. Economy. Tepid Jobs Report muddies Fed plans. By John Yeltsinruth. The disappointing jobs report released Friday leaves Federal Reserve officials without a clear-cut signal of an economy in the mend, creating a dilemma for the central bank, as it contemplates pulling back on a landmark bond buying program designed to stoke growth. Many investors have grown convinced in recent months that Fed officials would take a first step toward reducing the $85 billion a month bond buying program at their September 17th to 18th policy meeting. The program has become an almost daily obsession in markets, and the prospect of its shrinking has pushed long-term interest rates higher, while stocks have seesawed. Friday's jobs data did little to move the needle in either direction. Employers added a steady, if unspectacular, 169,000 jobs in August, and the unemployment rate fell to 7.3% last month. That's notable improvement from the 8.1% unemployment rate when Fed officials launched the latest stimulus program late last year, but job growth has been anemic in recent months, below the 200,000 a month level some officials want to see. Financial markets were jostled by a variety of factors Friday, including angst about a potential U.S. military strike in Syria and the mixed jobs news. The prospect of the Fed moving more cautiously to pull away from easy money policies appeared to be one factor giving bonds a lift. In particular, the 10-year Treasury notes yield, which moves inversely to its price, fell to 2.936%. The rate had climbed overnight above the 3% mark for the first time since July 2011. Many Fed officials have been on the fence in recent weeks, wanting to see incoming economic data before deciding what to do at the September meeting. When Fed Chairman Ben Bernanke addressed the issue of pulling back on bond buying in a June press conference and later in July, he left himself wiggle room, saying the Fed would probably start pulling back later in the year, without specifying when. The Fed doesn't want to trim back its bond buying until it's convinced the economy is on solid footing and inflation, which is below its 2% target, will move back toward the goal. Now, as officials begin preparing for the meeting in a flurry of behind-the-scenes discussions, the issue isn't yet settled, according to interviews with Fed officials and their public comments. There is an expectation that we will act in September, Richard Fisher, president of the Federal Reserve Bank of Dallas, said in an interview Friday. Will we? It depends on the committee. Mr. Fisher is a Fed policy talk, who is eager to pull back on the program, because he doesn't think it's doing much good. He said the outcome was uncertain. Other officials want patience, but they are vague when discussion turns to the Fed's next decision. It is not yet time to remove accommodation, Charles Evans, president of the Federal Reserve Bank of Chicago, said in a speech Friday. However, in remarks to reporters after the comments, he left the door open. I'm going to go in left square bracket to the meeting right square bracket with an open mind. I can be persuaded about